ETH has been on an absolute tear recently, and talk of ETH season has been deafening.
It's deafening!
However, while most eyes are on ETH, several Ethereum-native names have quietly outpaced it and could keep doing so when liquidity rotates down the risk curve. And that's why today we'll break down 5 of the biggest altcoins riding Ethereum's wave, including how they came to be and just how wild the price action could get for their tokens. My name is Nick, and you're watching The Coin Bureau. Before we begin, you need to know that I am not a financial or investment advisor, and nothing should be considered financial or investment advice in this video. This video is purely for your education and entertainment, intended to inform you about 5 of the largest altcoins on Ethereum. Also, do note that some team members at Coin Bureau hold some of the tokens that we'll be covering today, but we promise to be as objective as always in our analysis. So, if you're ready to get into it, hit those like and subscribe buttons, smash that notification bell, and let's kick off with one of the bluest blue chips in Ethereum's ecosystem, Chainlink. As most of you know, Ethereum serves as crypto's primary settlement layer. And you could say Chainlink functions as Ethereum's decentralized data and connectivity layer. In plain English, Chainlink connects blockchains with both the real world and the broader crypto ecosystem. Its network of oracles deliver data feeds from off-chain sources like market indices and sports results to crypto-native information such as token prices or DeFi lending rates. All of this enables smart contracts to operate with trustworthy inputs. Chainlink was co-founded by Sergey Nazarov and Steve Ellis, first emerging under Smart Contract Limited way back in 2014. It subsequently raised $60 million through token sales in 2017, and its Oracle network went live on Ethereum in mid-2019, right as DeFi was starting to find product-market fit. Those 3 factors, credible founders, a war chest from the ICO, and a timely mainnet, explain a lot about why Link outpaced the broader crypto market at odd times in the previous cycle. On paper, Chainlink solves a simple problem, as smart contracts can't fetch external data by themselves. In practice, it's become a full-blown decentralized computing platform for crypto-native markets, as well as a bridge between TradFi and crypto. So, if you've done any kind of on-chain trading, particularly on Ethereum, chances are Chainlink has been working in the background to help facilitate it. Its website claims Chainlink oracles have enabled $24 trillion worth of transactions. At the same time, Chainlink's cross-chain interoperability protocol, or CCIP for short, has helped solve crypto's fragmentation problem. And that's because it enables token transfers and arbitrary messaging across chains with a security model anchored by Chainlink's Oracle network. Helpfully, Chainlink also has partnerships with some of the biggest names in TradFi. For example, Chainlink recently announced a partnership with Intercontinental Exchange, the parent company of the New York Stock Exchange, and this was focused on bringing foreign exchange and precious metals pricing data on-chain. And this is not a one-off either. Chainlink has been building strong relationships for its network development since its inception. Previously, Swift, the global bank messaging giant, ran its own real-world asset, or RWA, experiments with Chainlink. These are only a couple from many examples, and you don't need to squint to see the RWA path over here. Bear in mind that RWAs have grown to become a $25 billion market, and that's excluding stablecoins. The rails for traditional assets to settle, reconcile, and update across blockchains are being laid out in large part by Chainlink. Link's tokenomics have also been maturing since its earlier days, the most important development being the introduction of staking as a security and alignment tool. And it gets better. On the 7th of August, Chainlink launched the Chainlink Reserve, an on-chain mechanism that automatically converts the on-chain service fee and off-chain enterprise revenues into Link tokens. The reserve has accumulated over $1 million of Link so far, with no withdrawals planned for several years. How much of a bid the reserve mechanism will provide remains to be seen. But Chainlink claims that, quote, demand for Chainlink has already created hundreds of millions of dollars in revenue, and that would mean significant bids going forward, one would assume. Price-wise, Link has a habit of front-running broader cycles. It ripped during stretches when sentiment was grim and has overcome countless major unlocks. With market sentiment bullish and buying pressure helping to form a structural bid, Link has never been better positioned to thrive, at least on paper. So, Link's position in an ETH season is clear. It's at the heart of DeFi data, cross-chain settlement, and a roaring RWA sector. We believe current momentum will enable it to reach its 2021 all-time highs of $53. Next on our list, we have one of crypto's leading lending protocols, Aave. Now, Aave's story is crypto lore at this point. Stani Kaluchov launched ETH-Lend in 2017, and it has since raised nearly $50 million across various token sales. ETH-Lend eventually rebranded to Aave and shipped the pooled money market we know today in January 2020. When it comes to fundamentals, Aave seems to be ever expanding. Currently, Aave is generating an annualized revenue of over $130 million. Meanwhile, total value locked, or TVL, has ripped to all-time highs across chains, with a combined $40 billion in locked value, according to DeFi Llama. Pretty crazy numbers. I'd also be remiss not to mention Go, Aave's over-collateralized stablecoin. Community governance cleared Go to launch on Ethereum mainnet way back in July 2023. Then came the savings wrapper, Go, which is pitched as a low-risk yield product to deepen demand. This way, Go turns lending into a native monetary loop that can feed protocol revenue. As a result, Go has now reached $335 million in circulation, and is showing no signs of slowing down. It's not just Go either. Aave is still shipping major upgrades at the protocol level too. The upcoming Aave version 4 will use a so-called hub-and-spoke design, and this essentially makes markets easier to integrate and more modular or customizable. The latest update says a public testnet will launch next month, a clear sign of real progress. To boil it down a lot, if version 3 focused on smarter risk controls, version 4's goal is to make the system more flexible so governance can adapt faster while keeping it safe. On the institutional front, Aave Horizon is Aave Labs' initiative to connect institutional capital with DeFi by enabling RWAs to be used as collateral. It will run as a licensed, permissioned version of Aave with revenue sharing for the DAO. And this would bring more RWAs into Aave's ecosystem and enable it to expand like never before. But the most exciting part of Aave's story is a recent addition: buybacks. In March 2025, Aave's tokenomics overhaul advanced a revenue-sharing concept, and this ultimately kicked off open market Aave repurchases funded from protocol revenue. And sure enough, while Aave's revenue continues coming in, the buybacks follow, with over 16 million executed so far. Governance now sets the pace and scale of Aave buybacks, so there will be variation in the future. Nevertheless, the initiative has moved from approval to consistent execution, and establishing a structural bid for Aave tied to very healthy protocol revenue. Price action-wise, Aave's setup is clean. Version 4 is coming, the Go stablecoin is expanding, Aave Horizon is courting institutions, and the buybacks are quietly bidding in the background. With all of that momentum, it seems trivial to clear the prior all-time high of around $670. From there, we believe Aave can carve a path toward $1,600 in the long term, just under a 5x from today's current prices. Pretty nice returns if we continue with this bullish momentum. And if you want to maximize those returns, then you have to check out the Coin Bureau deals page. And that's because over there you will find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cashbacks on those deposits of 75% on the best crypto exchanges around. Now, these deals, they're only available to Coin Bureau viewers, and they won't be around for long. So take advantage of them ASAP using the link down below or by scanning this QR code. Now, back to our list. Next up, Ethena. Ethena's story starts with founder Guy Young, who set out in 2023 to build a crypto-native dollar that doesn't depend on banks. Ethena raised as much as $150 million, depending on your source, and the protocol launched in early 2024. Product-wise, Ethena's USDE is technically a synthetic dollar protocol built on Ethereum. Now, let's quickly define the distinction between a stablecoin and a synthetic dollar. Ethena's synthetic dollar, USDE, aims to hold a $1 value by running delta neutral hedges. And that means it buys spot crypto assets like BTC, ETH, and SOL, and then opens short positions on the same assets. Why? Well, because that lets Ethena be hedged in terms of risk and also collect fees for going short. It doesn't always work like that, but we won't get into the specifics in this video. Anyway, users can stake USDE to receive SUSDE, which is a rewards-bearing token that receives yield from the protocol. It may sound a little complicated, but it works, and the proof is in USDE's growth. Through late July and into August this year, USDE climbed into the number 3 stablecoin slot with a market cap of over 10.9 billion at the time of shooting, behind only USDT and USDC. It hit this milestone faster than any of today's top stablecoins, showing a pace of growth that's hard to overlook. Two structural catalysts help explain that curve. First, the US Genius Act finally put a federal framework around stablecoins and, crucially for Ethena, bars issuers from paying interest to the holders, and that steers demand toward crypto-native reward designs like Ethena's offerings. Second, Ethena and leading RWA service provider Securitize unveiled Converge back in March. Now, Converge is essentially a home base where Ethena, tokenized funds, and compliant rails meet. And this all puts Ethena in the category of regulated rails meets DeFi yield, a prime setup in the current environment. But it doesn't end there. July brought another headline-grabbing twist. A public vehicle dubbed Stablecoin X lined up $360 million of commitments for acquiring ENA. And that includes a $260 million plan to accumulate ENA on the open market as part of a broader crypto treasury trend. Looking forward, there are even more catalysts. Converge will continue to build out while governance has approved the framework for the ENA fee switch, advancing the idea that staked ENA could share in protocol revenues, with activation expected soon. When it comes to price action, ENA has lived the high beta life you'd expect from a protocol riding a hyped crypto sector that sees ebbs and flows. Since launch, it's traded from 20-cent lows to above $1 during 2024's risk-on spikes. Recently, on the back of aforementioned bullish developments still playing out, ENA has rebounded to around 80 cents. New all-time highs seem likely for a token with so much going for it, making $4 our price discovery target, a nice 5x from current prices. Now, we can't mention ETH season without mentioning the leading Ethereum Layer 2, Arbitrum. Off-Chain Labs, founded by Princeton trio Ed Felton, Stephen Goldfeder, and Harry Kolodner, raised a total of $143 million across 3 funding rounds before eventually launching Arbitrum in 2021. Fast forward to today, and the network leads Ethereum Layer 2s by TVL, $3.3 billion at the time of making this video. Arbitrum is one of the go-to venues for all manner of on-chain activity, and it's no wonder as Arbitrum has been shipping non-stop. The Stylus upgrade went live on mainnet in September 2024, letting developers write fast contracts in Rust, C, and C++ through WebAssembly while still working with the Ethereum virtual machine. Then came Bold, Arbitrum's new fraud-proof and validation upgrade. That allows anyone to run validators and challenge transactions, a big step toward further decentralization. And do note that Arbitrum has been criticized in the past for being overly centralized. In April this year, Arbitrum launched Time Boost, an express lane for transaction ordering that limits some exploitive bots and, importantly, started generating meaningful revenues for the DAO within months. On the ecosystem side, Orbit, which is Arbitrum's tool for launching your own chain, plays a big role in Arbitrum. It's a permissionless way to spin up layer 3s using Arbitrum's Nitro stack and staying within the Arbitrum ecosystem. Through Orbit, Arbitrum is building a growing set of niche chains, particularly prominent in crypto gaming. Then, of course, we have buybacks. Back in March 2025, Off-Chain Labs said it would gradually acquire Aave for its own treasury via open market purchases. Now, to be clear, that's not the DAO buying. It's the core maintainer signaling skin in the game as the product roadmap develops. That said, it's still unclear exactly how much Aave Off-Chain Labs has bought so far, or how much it plans to buy going forward. In other words, Aav's success probably won't be backed by a high-profile Michael Saylor type bid. Price-wise, Aave has done what any high beta ETH play will do: overreact in both directions. With the prior all-time high sitting around 4.5 times away at $2.40, the logical trade is simple. If ETH keeps driving hype, then the leading layer 2, which continues to ship products, is likely to see plenty of demand. At the time of making this video, Aave is attempting to flip resistance into support at around 51 cents. If that's confirmed on the back of ETH hype, the old highs become an obvious target. Clear that, however, and we have a price discovery leg, and that's where we're eyeing up the $4 level. And this, of course, all presumes an ETH-led risk rotation plus follow-through on the roadmap, but the play is clear, and the $4 target would be a nearly 8x from current prices today. Now, just as we couldn't exclude the leading layer 2, we cannot leave out the leading liquid staking protocol that plays a massive role in Ethereum's architecture: Lido Finance. Now, Lido went live on Ethereum in December 2020 to fix a problem for proof-of-stake mechanisms: the lack of liquidity of those staked assets. Lido lets you stake ETH and receive staked ETH, STETH, in return, a tradable token that accrues staking rewards while your ETH remains staked. The LDO governance token followed soon after. Lido's early cruise set the DAO-first tone that still defines it. Funding-wise, Lido has seen close to $170 million in investment since 2020. It's safe to say that Lido started strong and hasn't slowed down, as it still leads liquid staking by TVL, according to data from DeFi Llama. Lido's staked ETH remains the biggest ETH staking token in DeFi and a core piece of money market collateral. Lido's TVL has risen to an all-time high of $42 billion alongside ETH's rally, while pulling in more integrations from custodians, prime brokers, and market makers who follow liquidity. That network effect is Lido's real moat: sticky users and the broadest surface area where staked ETH simply works. Although the historical price action of Lido's LDO token has been lackluster, which we will get into a bit later, the protocol has a good track record of consistent protocol improvements. Lido launched simple DVT last year. In short, that means each validator is run by a group instead of one operator, spreading risk and bringing in more operators. And this was followed up by the community staking module, which, after an on-chain vote, became fully permissionless in early 2025, so anyone who posts a bond can run a validator. Then, earlier this year, Lido introduced dual governance, giving STETH holders a way to slow or block LDO-led changes with a dynamic time lock. All good progress toward more decentralization and security. Another area where progress is in the making: tokenomics. Recently, the Lido team held a token holder update call, wherein they said they were aligned with pursuing LDO buybacks, echoing ongoing DAO discussions. Multiple frameworks are on the table, but the team stressed the importance of taking time to consider the best approach. And this is particularly timely as regulatory clarity on staked assets is becoming clearer, and it's going in favor of the crypto industry. On the token holder update call, Lido co-founder Vasily Shapilov suggested taking a few months to consider the best mechanism before making a final decision toward the end of the year. Now let's get into that LDO price action. Since its launch, LDO has been rather disappointing. However, so was ETH during much of the same period, at least up until recently. With ETH's strength back, a repricing for Ethereum's leading liquid staking protocol has already begun. A run back to all-time highs would constitute a 3.5 times from current prices. But we think some price discovery could be in store for LDO if ETH maintains its strength and LDO receives positive tokenomic tweaks. A reasonable target in that scenario would be around $7, a roughly 5 times from current prices. Now, we could have gone into deeper detail on these 5 potential picks, and there are certainly far more than 5 tokens worth considering in the wider Ethereum ecosystem, and indeed beyond. So, let us know in the comments which altcoins you think have the most upside potential as ETH warms up the altcoin market. Which should we cover in the future? And if you want to learn more about Ethereum's potential this cycle, be sure to check out our video on that right over here. And if you're not subscribed to the channel, Well, you can do that right over here. Thank you all so very much for watching, and I'll see you in the next video.